A 71-year-old retired nurse from Columbus, Ohio named Evelyn walked into her bank last spring to withdraw $8,000 in cash. Not 10,000, not 11. 8. She had used that same branch for 26 years. She was withdrawing her own money. She had done nothing wrong. Her account was flagged, her transaction was delayed, and a report was filed with the federal government, but not because she hit $10,000, but because of a change in how banks are now required to watch accounts that belong to seniors. Evelyn had never heard of this change. Her bank did not tell her it was coming, and when she asked why her withdrawal was being questioned, the teller at the counter could not give her a clear answer. If you have a bank account and you are over 65, what happened to Evelyn can happen to you. And in 2026, it is happening more often than ever before. Today, I am going to explain exactly what changed, why the $10,000 rule you thought you understood is no longer the full picture, and the 3 specific things you need to do before your next large transaction to make sure your money moves the way it is supposed to. Stay until the end, because the third thing is the one almost nobody does. And it is the one that makes the biggest difference. If you are not subscribed, hit that button right now and turn on the bell. Banking rules affecting seniors are changing in 2026 in ways most people have not been told about. That is exactly what this channel covers. Subscribe, and let's get into it. Let me start with what most people already know, or think they know. The Bank Secrecy Act has been federal law since 1970. It requires banks to file a report called a Currency Transaction Report, or CTR, anytime a customer makes a cash transaction of $10,000 or more. That report goes to the Treasury Department's Financial Crimes Enforcement Network, known as FinCEN. Most seniors heard about this rule somewhere over the years. A neighbor mentioned it. A news segment covered it. And the version they walked away with was simple. Stay under 10,000 and you stay out of the system. That version was always incomplete. But in 2026, it is more dangerous than ever. Because the $10,000 number is no longer the main trigger you need to worry about. Here is what changed. Banks have always had the ability to file a second type of report called a Suspicious Activity Report, a SAR. Unlike the CTR, a SAR has no fixed dollar threshold. A bank can file one for any transaction, any amount, at any time, if their system decides the behavior looks unusual. What changed in 2026 is how aggressively that system is now being applied to seniors specifically. Under expanded safe harbor laws, now active in more than half of all states, banks are not just allowed to flag and freeze accounts they believe are being exploited. They are increasingly expected to do it. Regulators have been pushing banks to catch elder financial abuse earlier, and the way banks respond to that pressure is by expanding what their automated systems flag as suspicious. The result is a system that is now watching senior accounts more closely than ever before. Not for $10,000 thresholds, for patterns. A withdrawal larger than your recent average, a transaction at an unusual time of day, money sent to someone new, a large cash request that does not match your typical behavior. None of these things require you to hit $10,000. None of them require fraud. They simply require that your behavior today looks different from your behavior last month. And when the system flags it, the process moves fast. A compliance hold can go on your account automatically, before a human being ever looks at your file. Evelyn's $8,000 withdrawal triggered a flag because it was significantly larger than her usual monthly cash withdrawals. The system saw a pattern break. It reported it. She spent 3 days unable to access her full account while the review was completed. 3 days for $8,000 of her own money. Now I want to talk about the part of this that is getting seniors into the most serious trouble, because it is still the same mistake it has always been, but more people are making it in 2026 because they are trying to stay under a threshold that is no longer the only thing that matters. It is called structuring, and it is a federal crime under 31 U.S.C. section 5324. Structuring means deliberately breaking up cash transactions into smaller amounts to avoid triggering the $10,000 CTR requirement. $9,000 on Monday. $8,000 on Thursday. The government does not see 2 small transactions. It sees one deliberate pattern, and the law does not care that the money is legally yours. The act of arranging your withdrawals to avoid the reporting threshold is itself the offense. But here is what is new in 2026. Because banks are now filing more suspicious activity reports on senior accounts, reports that have no fixed threshold, the combination of structuring behavior and an existing SAR flag is creating a much more serious problem for seniors than it did even 2 years ago. A senior who breaks up withdrawals to stay under 10,000 and whose account is already being watched because of recent pattern changes is now looking at the possibility of both a structuring investigation and a senior financial exploitation review running at the same time. These are two separate federal systems, two separate sets of potential consequences, and they can feed each other in ways that are very difficult to undo. Think of a man I will call Gerald, 69 years old, from Albuquerque. He needed to move $15,000 from his savings to pay off a medical bill. He had heard the 10,000 rule his whole life and decided to take it out in 2 withdrawals over 2 weeks. At the same time, his bank's automated system had already flagged his account once that month for a pattern change. He had made several online transfers he did not usually make. The 2 flags combined, his account was frozen, a SAR was filed, and Gerald spent 4 months in a review process that required him to document the source of every dollar in his savings account going back 3 years. His money was completely honest, but proving it took 4 months, a significant amount of stress, and 2 conversations with attorneys. Gerald told me afterward, "I thought I was being careful. I did not know that being careful was the problem. So what do you actually do?" Let me give you 3 specific things. Not general advice. Specific actions you can take before your next large transaction. The first thing, make large cash transactions in one clean withdrawal and let the CTR be filed. If you need $12,000, withdraw $12,000. The bank files a currency transaction report. That report goes into a federal database. For honest money, nothing happens. No phone call, no investigation, no letter. The report is a routine regulatory filing, not an accusation. The danger was never the report. The danger is the pattern that looks like you were trying to avoid it. One clean transaction, one routine form, 0 consequences for money that is yours. The second thing, call your bank 3 to 5 days before any large or unusual transaction and put a written explanation on your account record. This is the step most seniors skip, and it is the one that prevents the most problems. When you call, say this: "I am planning to withdraw this amount on this date, and the reason is this. Please note that on my account record." That one conversation does 2 things. It gives the bank's compliance system a legitimate explanation before the transaction happens. And it creates a paper trail that shows your intent was transparent, not evasive. Announced transactions do not look like suspicious transactions. Surprise transactions, even completely innocent ones, do. If your transaction involves sending money to a new person, the same rule applies. Call ahead. Explain who the recipient is and why you are sending it. Note it on your file. The third thing, add a trusted contact to your account today if you have not done it already. A trusted contact is not a joint account holder. They cannot access your money, see your balance, or make any decisions. They are simply one person, a son, a daughter, a close friend, whose name and phone number sits on file at your bank. When your account gets flagged and a hold is about to go on, the trusted contact gives the bank a human alternative to an automatic freeze. One phone call. Your daughter confirms she knew about the withdrawal. Your son says yes, Dad mentioned that transfer to me. The freeze does not happen. Your money moves. You never know there was almost a problem. Call your bank today and say, "I would like to add a trusted contact to my account." It takes 5 minutes. It costs nothing. And it is the single most effective thing you can do to protect yourself from an automated system that cannot tell the difference between a scam and your normal life. Let me bring this back to Evelyn. She did not hit $10,000. She did not structure anything. She did nothing wrong, but her withdrawal broke a pattern that the bank's automated system had been trained to watch for. In 2026, that is enough. The 3 things I just gave you, one clean transaction, a phone call before you go in, and a trusted contact on file, are what would have prevented everything that happened to her. Not complicated, not expensive, just information she did not have in time. You have it now. Share this video with one person you know who is over 65 and has a savings account. Because the rules around senior bank accounts changed in 2026 in ways most people were never told about. And the seniors who get caught are not the careless ones. They are the careful ones, working from a version of the rules that is no longer complete. Subscribe and turn on the bell. I will see you in the next one.